You know that feeling, right? You walk into the grocery store, pick up the usual stuff, and then the total at the checkout just feels, well, noticeably higher than you remember from last month.
Oh, absolutely. It's not just a feeling for many people, it's the reality. And that's exactly what we're digging into today.
Yeah, this deep dive is all about understanding the current inflation picture, and we're focusing on what one really interesting report from the Macro Butler is calling the Trumpflation crunch.
Exactly. It's a detailed look. And our goal here is to unpack the key insights from that Macro Butler newsletter. It's titled, From Paycheck to Pinch, the Trumpflation Crunch Ahead.
We want to cut through some of the noise, get to what's really going on with prices, with wages, and just the broader economy, beyond the quick headlines.
Right. So let's get into it. What's the latest snapshot telling us?
Okay, so let's start with the July inflation numbers, the CPI data. The main headline figure, it looked, well, kind of modest, didn't it? A 0.2% rise month over month.
Yeah, 0.2%. That was actually a little softer than June's 0.3. So on the surface, maybe some relief.
But the year-on-year number, that's where the drama, as the report calls it, comes in. It stayed put at 2.7%, didn't drop like some expected.
Exactly. It missed the 2.8% forecast and just held steady from June. And a big reason it wasn't higher was energy prices, especially oil. They kind of kept the lid on things.
So energy was the show-off, keeping deflation hopes alive, yeah?
Sort of, but underneath that, goods inflation actually made quite a comeback. It had its hottest year-on-year reading since June of last year, 2023.
Interesting. So less pressure from energy, but more from actual stuff, from goods. And what about food?
Well, the report says food prices are clinging on, still stubbornly high. And core services, they just kept trudging higher at a steady 2.2% annualized pace. No let up there.
Okay, so let's talk about core CPI then. That's the one without the volatile food and energy, right? Gives a clearer underlying picture.
Precisely. And core CPI rose 0.3% in July. That was expected, but like you said, a touch warmer than June's 0.2%.
And year on year.
That nudged up to 3.1%. It actually beat the 3.0% forecast. So that's a clear reacceleration from June's 2.9% and the fastest yearly pace since back in January.
Wow. And the report mentioned something about 62 straight months of core gains.
62 months, yeah. Uninterrupted core CPI gains. It's quite a streak. Shows how persistent this underlying inflation has been.
That's significant. What about rent, the owner's equivalent rent, OER? That's a big chunk of CPI.
Right, the so-called zombie of CPI. It came in at plus 4.1% year on year. Now that is its chilliest level since January 2022, so some cooling there.
Okay, some cooling in rent. But there's another core measure the Fed watches closely, isn't there? Supercore.
Ah, yes, supercore. That's core services excluding housing. The Fed's pet metric, as the newsletter puts it, and that one, it actually sped up.
Sped up after all the talk about inflation easing.
Yep. Jumped to 3.21% year-on-year in July, up from 3.02% in June. That's its fourth straight month of reacceleration.
Fourth straight month. So that really challenges the idea that inflation is beaten.
It does. The newsletter puts it, well, pretty provocatively. They say inflation has totally vanquished. If you squint hard, forget about rent, food, and reality, and inhale a generous puff of hopium.
Huh. Okay, so a bit of skepticism there about the inflation victory narrative. Given these mixed signals, how did the markets react? Did they buy the hopium?
Well, initially, yeah. Wall Street kind of popped the champagne, or maybe the Costco sparkling cider, as the report jokes. The S&P 500 and NASDAQ hit new all-time highs.
So investors focused on the slightly softer headline number, maybe?
Seems like it. They clung to that fairy tale rate cut fantasy. Markets are still pricing in a rate cut for September, a 25 basis point trim.
Even with the core and supercore accelerating and some Fed governors sounding more hawkish.
Even with that hawkish grumbling, yeah. Meanwhile, the dollar index slipped a bit, and gold lost some of its sparkle. So definitely a bit of a disconnect there between the data and the market's immediate hopes.
Okay, let's unpack this term. The newsletter uses the Trumpflation train. What exactly do they mean by that?
Well, the core idea presented in the newsletter is that the brief dip we saw in inflation, maybe deflationary pressures in the first quarter, that was just a blip, a fluke.
And now?
And now, they argue, this reflation train has left the station, and it's bringing tariffs along for the ride, the tariff tax, as they call it.
So reflation driven partly by policy, like tariffs. And how does the newsletter see this playing out?
Their view is that this kind of reflation does two things. It squeezes corporate profit margins, but it also acts like a tax on consumers, pushing prices up.
Okay, so it impacts both businesses and individuals. This obviously raises big questions about the Federal Reserve's goal, right? that elusive 2% inflation target.
Absolutely. The newsletter is pretty blunt about it. They call hitting 2% inflation by the end of the year a pipe dream.
Why so pessimistic?
Well, their math suggests that for CPI to get down to 2% by year end, the monthly prints would basically need to go negative. They'd have to moonwalk below 0% monthly.
Which seems unlikely given the recent numbers.
Very unlikely. Their forecast is pretty stark. If we keep seeing monthly prints around 0.2% or maybe even higher, they project we could be looking at CPI between 3.4% and 5.0% by the end of the year.
Wow, 3.4 to 5%. That's way off target. So what does that imply for the Fed?
It leads the newsletter to pose this really interesting question. Could we actually see an autumn rate hike? If inflation stays this sticky or reaccelerates further, would the Fed have to admit they maybe paused too soon and actually raise rates again?
That would certainly shake things up. It highlights the really tricky spot the Fed is in right now.
Definitely. And while the economists debate these big numbers, the report really brings it back to the everyday impact, doesn't it?
It does. It kind of challenges that whole transitory inflation idea by just saying, take a stroll down the grocery aisle. You feel it there.
And they back it up with data. The UN's food price index, the FAO index, hit 130.1 in July 2025. Now, okay, that's not the crazy peak we saw in March 2022.
But still high.
Oh, yeah. It's up 7.6% from last year. And get this, 37% higher than it was back in July 2019, before all the recent upheaval. So food costs are structurally higher.
37% higher than pre-pandemic levels. That's huge. And it's not across the board, is it? Some things are worse than others.
Right. The report breaks it down for July 2025. It says meat and vegetable oils were the ones deciding to party, pushing prices up. Vegetable oils hit a 3-year high. Meat prices, yet another record.
While things like cereals, dairy, sugar were more stable.
Yeah, they stayed home, as the report puts it. So you might notice it more depending on what's in your specific shopping cart.
Which brings us to the other side of the equation, wages. Are paychecks keeping up with these rising costs? Is that magic trick reaching workers' bank accounts?
Well, the report paints a pretty concerning picture here using Atlanta Fed data. It suggests that 40% of Americans are now earning less than what's needed for a basic living standard once you adjust for inflation.
40%. That's
Yeah.
a huge number of people falling behind.
It really is. Now, there's a divide. The data showed 57% of workers did get raises that beat inflation over the past year. That's good news for them.
But that leaves the other 43%.
The other 43% are essentially watching their lifestyles slowly deflate, as the report says. Their wages aren't keeping up with the rising cost of living.
So what's the overall picture for real wage growth after inflation?
It's pretty minimal. The report cites a whopping 0.7% real wage growth. That translates to maybe an extra $9 a week for the average worker.
$9. Just enough to buy. Maybe a sandwich, like the report says?
Maybe, if it's not a fancy sandwich. And if you look at broader trends, like the Indeed wage tracker, it peaked way back in late 2021 and has really cooled off since.
So wage growth is slowing down just as inflation stays sticky.
Exactly. Wage growth is now barely keeping pace, making that gap between wages and inflation the thinnest it's been in a year.
And you can imagine the anxiety this causes.
Absolutely. The report highlights some stark numbers. 76% of low and middle income households feel their financial well-being is in jeopardy, and 86% are anxious about grocery prices. Over half, 53%, call rising grocery costs a major life stress.
That really drives home the paycheck to pinch reality.
Yeah.
It's not just numbers. It's real stress for millions of families.
Precisely.
Now, the newsletter dives into some, well, less conventional ideas about what might be driving some of this, particularly food prices. It talks about solar cycles.
Yeah, this is a fascinating, if somewhat unconventional, part of the report. It introduces the idea of the mother of all cycles, the solar cycle, suggesting the sun might be a cosmic puppet master influencing things down here.
How would that even work? Less solar activity affecting prices.
The theory presented, and it is a theory, is that lower solar activity impacts Earth's magnetic field, potentially leading to planetary cooling. This cooling, the idea goes, might even affect the Earth's crust, something the source calls tectonic exfoliation.
Wow. Okay. And they even mention a potential grand solar minimum, like a super cycle.
Right, a supercharged boss-level version. And the report tries to link historical cold periods, potentially linked to these minimums, with societal upheaval.
Like what?
Well, they mentioned the Dalton minimum coinciding with the French Revolution, which also involved a manipulated wheat shortage. They point to 536 AD, a famously bad year with cold and famine, possibly linked to volcanic activity. and the Spurrier minimum during the Black Death.
So the controversial idea is that maybe food prices are sometimes driven by these bigger natural forces, not just, central bank policy.
That's the provocative thought they raise. They bring up W.S. Jevons's old sunspot theory, linking solar cycles to agriculture, and even Irving Fisher trying to connect sunspots to market crashes.
It sounds pretty out there, but are there any modern examples?
They cite Japan's rice apocalypse in early 2025, where prices doubled, possibly linked to weather disruptions, which could be influenced by these larger cycles. But, and this is really important.
There's a caveat, right?
Yes, a crucial one. The newsletter itself acknowledges that while the sun cycle might poke food prices now and then, in today's world with advanced agriculture, irrigation, mechanization, fertilizer, it's just one player in a crowded field. It's not the sole driver.
Okay, so an interesting theory, but keep it in perspective. What about the more grounded drivers, the man-made chaos the report talks about?
Right, it shifts gears to focus on factors like government policies described somewhat critically as Malthusian and geopolitical tensions, especially with the potential return of the disruptor-in-chief.
And they see a direct link to prices.
They show a correlation. They plot U.S. food CPI against something they call the Chaos Index, which combines measures of economic policy uncertainty and geopolitical risk. And visually, those lines move in lockstep,
Implying that more policy uncertainty and geopolitical tension equals higher food prices.
That's the correlation they highlight. And it's not just food. They show a similar cozy correlation between this geopolitical drama and energy prices, specifically WTI oil.
So it's a complex mix, maybe some background cosmic hum, but definitely overlaid with very real human policy and geopolitical factors driving costs.
Exactly. It's a convergence of forces.
Which leads the newsletter to define this environment as the great inflation squeeze. What do they mean by that?
It's the combination of factors we've discussed: climbing prices, the impact of tariffs, wage growth that isn't keeping up for many, a potential economic downturn, and maybe even job displacement from things like AI, all hitting at once.
That sounds cool. Yeah, like a squeeze.
Yeah.
And they suggest this is where the Trumpflation idea could actually morph into something else.
Yes, that's where they predict it could transition into Trump stagflation. Stagflation being that nasty mix of stagnant economic growth and high inflation.
Not a great scenario.
Yep.
In that kind of environment, does the report suggest who might actually benefit? Or at least weather the storm better?
It does offer an interesting example, the Cargill-Macmillan family. It describes them as a family quietly getting filthy rich amidst this kind of volatility.
Cargill, the agricultural giant.
The very same. Their stealth empire started way back in 1865. The report states they control something like 22% of U.S. beef, and along with just 3 other firms, dominate a huge chunk, maybe up to 90% of the global grain trade.
And they're privately owned, right? So less public scrutiny.
Exactly. It allows for what the report calls quiet domination of the food chain. They're positioned to potentially benefit from price volatility in commodities.
That's a powerful position. So given this outlook, sticky inflation, potential stagflation, complex drivers, what's the investment takeaway from the newsletter?
Well, the starting point is a historical observation. Collapsing public confidence, often fueled by political issues and conflict, tends to lead to economic turmoil. So rule 1 is don't just sit around daydreaming about 2% inflation returning anytime soon.
Okay, be realistic. What should investors actually do?
The advice is pretty clear. Seasoned investors are already adjusting. They strongly advise avoiding long-dated government bonds. The risk is too high if inflation stays elevated or rates go up.
So get out of long-term bonds. What should they move into?
The focus shifts to hard assets. Things like gold and quality stocks are seen as your bunker. They specifically emphasize physical gold as the anti-fragile asset.
Anti-fragile meaning it actually benefits from chaos and uncertainty.
That's the idea. Silver and other hard commodities are also mentioned. For stocks, they favor low-leverage companies with strong EPS and FCF growth companies that generate solid earnings and cash flow without relying heavily on debt.
Makes sense. Less debt means more resilience.
Yeah.
Any other key strategies?
Yes, prioritize energy producers over consumers. And for managing cash, don't just leave it sitting idle. Actively manage it, perhaps through sub-12-month investment-grade corporate bonds, shorter-term, relatively safe debt.
So a definite shift towards tangible assets, quality companies, and shorter-term actively managed cash. Is there a sense of urgency?
There is. The newsletter includes a warning that the U.S. economy may be only 3 to 6 months away from shifting into an inflationary bust, i.e. stagflation, and that shift will be painful for investors who haven't prepared.
3 to 6 months, that's not very far away.
I-
Stark warning.
It is, and it underscores their broader point about things like trade wars. Ultimately, they argue consumers and businesses within the countries imposing them tend to lose out.
Okay, so let's try and wrap this up. Recapping our deep dive into the macro butlers from Paycheck to Pinch report, what are the main takeaways?
Well, first, inflation is proving stickier than many hoped. We saw that in the July CPI, especially the reacceleration in core and, importantly, super core CPI.
Right, that 2% target seems like a really tough climb from here, maybe even a pipe dream, according to the source.
And that stickiness translates into a very real pinch for households. We see it in stubbornly high grocery prices and wage growth that, for almost half the workforce, isn't keeping pace.
Then we explore the drivers, the conventional ones like policy and geopolitics, the man-made chaos, but also those more unconventional ideas like the potential long-term influence of solar cycles, even with the caveats.
And all this potentially points towards a shift from simple reflation towards stagflation, the so-called Trump stagflation scenario, which requires a different kind of preparation from investors.
Definitely a lot to think about. It seems understanding these dynamics, from the checkout aisle to, well, potentially even the sun, is more crucial than ever.
It really highlights the interconnectedness of it all.
So here's a final thought for our listener building on this. In a world where, as we've heard, cosmic forces, geopolitical chess moves, and policy decisions might all be converging on your grocery bill, what unexpected truth about how our economy really works might reveal itself next? And maybe more practically, thinking about this paycheck to pinch reality, what's one simple action you could take this week to make yourself just a little bit more financially resilient? Definitely something to mull over.